Welcome to Trader TV. I'm Dan Barnes. With the US election coming up on the 3rd of November, we might expect markets to be volatile. We're going to speak with Dwayne Middleton, the global head of fixed income trading at T Rowe Price, to understand liquidity conditions and volatility conditions in US fixed income markets this month. Dwayne, thanks for coming on the show.
Hi, Dan. Thanks for having me.
So tell us, how would you characterize liquidity conditions in US fixed income across credit and treasuries this month?
Unlike last fourth quarter, where you had a lot of fluctuation in, say, the repo market, I don't think that's going to occur this year because of what the Fed has done and the deposit growth at banks. So I think there's plenty of liquidity in the system to alleviate any kind of that regulatory gymnastics that typically occur in the fourth quarter. So I think that's one positive for liquidity conditions. I think, dealers' balance sheets are still pretty robust. They may not be deploying them fully, but if there is a left tail event, the Fed is really kind of positioned to deal with any kind of plumbing issues, so to speak.
And are markets particularly volatile now?
If you look at equity volatility, I think we're up around 28, 29 on the VIX. So clearly there's some expectations, and that could be election, Brexit, COVID cases increasing, that sort of thing. To me, those are all kind of known kind of outcomes. It's hard to see a return to March level volatility, just given all this central bank activity that's occurred. And in addition, the rally in spreads that we've seen and yields. If you look at rate volatility, for example, the 10-year yield, the variance has only been roughly 30 basis points. And I think that's a decade low in terms of yields changing. If you look at the retracement in credit spreads, it's roughly 70 to 75%.
Yeah.
Using the Barclays indices, we're roughly at 120 basis points on an OAS basis. If you look at high yield using the same kind of benchmark, we're roughly at a $103 price. So clearly there's been a pretty dramatic recovery. Technicals in credit markets are as strong as they've ever been.
Yep.
So, and that's two reasons. Foreign buying activity has been increased. While you've had a flood of supply and, net debt on aggregate has increased, you can start to paint a picture that a lot of that supply is going to start to wane. And some are calling for, IG supply to be down 30% year over year next year. So you're almost shaping up where it's going to be hard to source alpha opportunities.
Sure. It's really interesting how that central bank interaction with markets is playing then, of course, because you've got a certain amount of fixed income asset buying by the central bank, but actually at quite low levels. But just the willingness to support the market seems to be having a significant effect. Then, of course, you've got very low rates. So all in all, that seems to have dampened down volatility. That's what we're saying.
The Fed credit programs really kind of were a backstop measure and, really kind of taking out that left side or, negative tail risk. So once you remove that got people comfortable that they could make, their investment decisions. And, I'd say from March to maybe July, it was probably more of a beta play in terms of just, getting aggregate exposure. Now I think security selection, sector selection are really going to drive that kind of alpha opportunity.
You mentioned that dealers actually do have some risk appetite. Occasionally we see towards the end of the year, especially when the banks have made a lot of money earlier in the year, they tend to be a bit risk off because the opportunity is there versus the risk isn't necessarily something they want to take. But it sounds like they still have risk appetite. That's good.
I think dealers are perfectly willing to, make single name, alpha target bets, for example, or take attributes from the buy side and construct. I mean, portfolio trading is still a growing trend within the credit markets. One way dealers express their not so much a balance sheet constraint, but they'll frame the market wider. But to me, that's an opportunity, if you have good price inputs coming into your platform to kind of really be an aggressor inside that bid offer. And I mean, you see that showing up in, market access open trading, for example.
How is your team achieving best execution in the current conditions? What sort of trading protocols are you favoring?
Our consultative conversations with portfolio managers, research analysts has really centered around, what are we trying to accomplish in client portfolios or on a particular order? And what's kind of the best trading protocol to pursue that? So if it's a vertical slice of a portfolio to manage a cash flow, we might just use the traditional RFQ protocol. But if it's, say, a single name opportunity where, we have a belief and, pretty confident on the level that we want to execute at, we might pursue more of the, anonymous or all-to-all trading protocol. Or, in turn, if we get, say, attributes from a portfolio manager, we might look at a portfolio trading opportunity. So it's really, embracing all the tools that we have available to ensure best client outcomes.
So having a wide toolkit is really the key.
I think so. I mean, we're in this kind of multi-asset fixed income world, and you need as much flexibility as possible.
That's great. Dwayne, thanks very much.
Sure. Thank you. Thanks for having me.
I'd like to thank Dwayne for his insights, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradietv.net or etftv.net.